Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to jump into a question or comment. I'm going to answer it. It's on the YouTube channel. And I'll give you my financial opinions around it. We'll dig into a little bit of data. We'll go into some quotes of some famous investors. And I'll give you kind of a well-rounded, hopefully a well-rounded answer to it. So let's dive into the question. It is 2023. We'll let everybody know on this channel if Andy is right or wrong. Will there be a massive global recession slowdown? It's very easy on a global reopen trade on energy with massive liquidity on the trillions all over the world. If we are truly in a commodity supercycle, Andy will be right and no recession will stop it. Let's see how strong commodities are in a global recession. Some countries' depressions, 2023, 2024, rubber meets the road. Well, I don't know. I mean, it doesn't matter if I'm right or wrong necessarily. What matters is if I'm right, how much do I make? And if I'm wrong, how much do I lose? Or even if I'm wrong, I might still make money. Depends on what the circumstances are. You can have a commodity super cycle and a recession happen and prices go down for a short period of time. I will show you that. I'm not claiming that commodities will relentlessly go higher. In fact, I've made many comments about commodities in a bull market having 50, 60, 70% pullbacks. So how would you know the difference between a recession causing that pullback or a normal pullback in a bull market? And that's where I think people get tripped up. So what you're going to do, and what a lot of people do, is they'll make a statement. They'll say, we don't have a commodity bull market because the price pulled back 40 or 50%. But that is what happens in bull markets. That's not enough data to state that you're not in a commodity bull market. If you know Elliott wave theory, the first wave and the pullback after the first wave is generally a 61% pullback. So you can be in a commodity super cycle and you can have recessions within it, and prices will go down during those recessions, and you're still in the commodity super cycle. What solves a commodity deficit is supply. What I am saying is that the supply is not there. Now, I'm not projecting that I know when this recession or if this recession is going to come. I don't know when. And a lot of the times I said I'm going to ride through it. And the way that I view this recession is it's very similar to we'll call it the early 2000s, the dot-com bubble recession. I think it's very similar to that recession. I don't think it's going to be a 2008. Could I be wrong? I very well could be. 2008 was a recession driven by a deleveraging in the system. I don't think that we are at that spot in the housing market yet. I think that's years away if it's going to come. We don't have the inventory. We don't have the foreclosures. We don't have the delinquency rates. When we look at the Fed delinquency rates, we don't have that going up. It's not there yet. So if we are going to get a recession, I think it will be mild. That is an opinion. I could be wrong. I very well could be wrong. And it's not about me being right or wrong. It's about how I've positioned, how much money I'm going to make off of it, and how much money I'm going to lose off of it. What's my risk reward? That's what investing's about. Now, I'm going to read you guys some quotes. I brought this up. We've got some quotes here, and I want you to kind of get their opinions on this. And I think I'm still in this picture here. There we go. So here's some quotes that I want to read. Here's Peter Lynch, one of the most famous investors, very high returns. I think he averaged 29.2% per year for a very long period of time. This is what his opinion is. It says, you get recessions. You have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. So one of the most successful investors in the world of all time is saying, look, we're going to get recessions and market declines. Expect it. And two, don't try to prepare or anticipate it, because those who have tried to anticipate it and time it correctly have generally lost more money trying to anticipate them than the actual corrections themselves. Coming from some are, what I would consider to be some of the most, we'll call it successful investors in the world. Here's Warren Buffett. We've long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also away from grown-ups who behave in the market like children. So there's Warren Buffett trying to time this market to the T. He is saying you shouldn't be doing it. So now we've got a couple of the most successful investors in the world saying, you know what? I'm not going to try to time this recession. Peter Lynch, Warren Buffett. And what do you think I'm doing? I said, I'm going to ride through whatever recession we have. That could mean that we go down in price for commodities for a short while of time. Maybe it's a year or two. Here's Jesse Livermore. He says, it was never my thinking that made the big money for me. It was always my sitting. It's always my sitting. First, do not be invested in the market all the time. There are many times when I have been completely in cash, especially when I was unsure of the direction of the market and waiting for a confirmation of the next move. Second, it is the change in the major trend that hurts most speculators. And that is where we are at. It is the change in the major trend that hurts most speculators. That is what I caught. I caught the major trend at its inflection point at the bottom for the turn in commodities. Now, what should I be doing? It was never my thinking that made the big money for me. It was always my sitting. If you catch the major trend, the next thing to do is to sit and wait. And if these guys who are successful investors are telling you, basically, short-term market forecasts are poison and should be kept locked up in a safe place. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. If they were my mentors and they're saying this, what do you think I'm going to do? I nailed the major trend change, in my opinion. I think a commodity super cycle is coming for a variety of reasons that I've talked about in many videos. And these guys are saying it's always was my sitting. And you guys are worried about what could potentially come. It says, trade only the pivotal points. I always made money when I was patient and traded on the pivotal points. The pivotal points. So let's look at what Jesse Livermore created. He created this Livermore accumulation cylinder with widening mouth. This is Livermore's speculative chart. You get a 1, 2, 3, 4, 5, 6, 7, and then you get a big old run after it. This is herd mentality that he is basically what he has here. This is how the herd behaves. So what I do is I know a lot of these patterns. I've looked at them. I'm going to basically copy this pattern and let's go see if we can find this pattern. So here's the pattern. We've got it. I'm going to go back to, I'll go to natural gas here. And I talked about natural gas in that video clip where he's making the comment. He's saying 2023 and 2024 is where the rubber meets the road. Well, here you go, guys. This is Livermore cylinder and natural gas. Let me put it on one here. I'll just zoom out a little bit and get this thing kind of prepared as best I can in here. So there's the cylinder, right? 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. And we're at the bottom of 7 right now, and it's trying to find a bottom in natural gas. And what this is this is human behavior. This repeats over and over and over in the stock market. And this is just one of the patterns. It's not all of the patterns. And when I go and I look at all the commodities, they are putting in massive bottoming patterns. Now, does this mean that this will stop exactly right on this line? It may not. It may go down a little bit more, but it's a general rule. And as the humans accumulate natural gas like this, we know that they're accumulating because of the pattern it is creating. And it's not just this pattern. It's across the board of commodities that I am seeing accumulation patterns in inverted head and shoulders, double bottoms, etc., etc., etc. We are also seeing a pivotal point change, like Jesse Livermore said, where the patterns are topping patterns in other areas. Like here's Amazon, for instance. An increasing interest rate environment puts pressure on growth stocks. Growth stocks are priced off of future growth. What do I think Amazon kind of looks like here? So here's Amazon stock. This is what I would guess. And I'm just guessing here. This is going to be your neckline. It's going to go up like this. And then you're going to get a head and shoulders, and it comes back down. That is what my guess is. And I called that back even in 2021 when the money was printed and the shortages of commodities were coming. I said, what I'm expecting is the tech sector to roll over from higher interest rates. Everything has come and played out the way that I thought it was going to play out. And it's not about me being right or wrong. That was a stance that I have held based off of the money in the system, the expansionary phase of real estate, etc., etc., etc. I'm still bullish on real estate, but in the short term and where the interest rates are, we are having a slowdown. It doesn't mean that it's over yet. And that's where I think people are too quick to make judgments or statements. They think that when something goes up, they're like little squirrels that run around. They think, oh, it's great. Oh, it's a bad investment. Oh, it's great. Oh, it's a bad investment. They have to take a longer time frame than just your day-to-day, month-to-month, week-to-week movements that you see in the markets. That is what separates very well-off billionaires versus people who are going to be poor the rest of their life. They figure out how to play the game, and then they play the game very well. And having a short-term time frame is not the time frame to have. Just like Buffett says, just like Peter Lynch, these guys bought stocks and businesses and held them for decades. That is how they got their returns. They bought undervalued businesses and played the big long-term game. Now, Buffett's he's all up in oil right now. He sees, I think, probably what I see, or I see what he sees, however you want to say it. Now, I'm gonna do a little example here. This is just the Livermore cylinder on a different stock. This is about herd behavior, and I want to show you guys a little something here. So this is Rare Element Resources. It's a small little stock. I'm gonna delete some stuff out here real quick so it's a clean one and I can grab a clean one. This here is the Livermore cylinder. And you can see the Livermore cylinder play out in real life. So the Livermore cylinder is this accumulation zone. So it's 1, 2, 3, 4, 5, 6, 7. Then you break out into 8, 9, and 10 is the top. And then you roll back over into this consolidation period. What I'm going to do is I'm going to take the run up in it. Oops, wrong one. I'm going to take the run up in it. Hold on. I got to grab the wrong one here. I want bars pattern. I'm going to take the run up here. That's the run up. This is the Jesse Livermore cylinder, all right? And I'm just going to play with this. I'm going to go to natural gas and go to this the cylinder here that we have. I'm going to paste this in here of rare earth. And I'm going to overlay it, blow it up, and show you guys what this looks like and how well it basically subscribes to this. There, it's like right in this area there. So this guy is this guy. This guy is that guy. This one is this one. You can see the run up here, and obviously it's stretched and squeezed a little bit. This is the peak there. This is the peak there. This is the peak there. And then I think we'll have two little humps or something on the lines of the momentum coming down, working itself off. And then I think we're going to have the big run. And remember, this isn't the run. The big run it's going to go, up here or something, all the way to 19 or 20 or 14 or whatever it goes to. But that is the Livermore cylinder, and that is another stock in the humans interacting with each other and how it aligns to natural gas. Now, my question is, I'm showing you evidence. I'm gathering evidence of this particular stock here. Now, if I run and I looked at the equities of all this, they all have inverted head and shoulders. They've got double bottoming patterns, and they're all in areas where they could potentially go higher. Now, if I were to look at last bull market, and I'm showing you like the big picture view here. If I go back and I look at the last bull market of crude oil, I'll just use crude oil here. And I go back to, and I've got the circles there. Hopefully they come up quick. Here we go. So these are the circles. This is the last bull market. This is the beginning of the bull market for the commodity to stock ratio. This is the end of the bull market for the commodity to stock ratio. This is the bull market, and what we're going to try to do is capture the majority of this move. Now, there's a couple of pullbacks in here. Does this mean that the super cycle's done if we pull back like that? And does this mean that the super cycle's done if we pull back? And how do you know with these little pullbacks all in here? These are all very big pullbacks in this bull market. How do you know if that's a pull, that pullback is the end of it or not? How do you know that? And how do you know how long that pullback will be? And here, let's measure some of these. So here's a pullback in, well, it's under this one here, price range. This pullback here is 53% in crude oil. This here is your first wave. Your first wave is here. This is the bottom of the second wave. Your third wave is here. And then your fifth wave is this kind of blow off extended fifth wave top. And to nail the top of this, to nail the bottom of this, it's going to be pretty difficult because you're going to have a lot of these pullbacks as you go. I can even measure some of these other ones from this one down to here. That's a 37% pullback. And then, we've got this one here, and there's a whole bunch. That's a 22% pullback. And I can just keep adding them and adding them and adding them. This one here, 36% pullback. We've got all these pullbacks, and there's more than just what I've put here. Now, what happens is, and this is what I don't like, is this is the last bull market. Those are the pullbacks. That's kind of what it looks like. So we get all these pullbacks, and they're larger than 20, 30% pullbacks. One's 53.8. This is what people are going to do. You're going to see this 53.8. They're going to say it's not a commodity super cycle. You are wrong. But guess what? It's a commodity super cycle. So yes, this pulled this back under the recession of 2000 to 2001. But the dynamics here are different. This was a liquidity cycle in 2000 to 2002. Back here, this pullback was the dot-com bubble bursting. And it was a 53% decline in crude oil. The super cycle still remained. And it doesn't mean that commodities are going to be immune to a pullback. It does not mean that. It does not mean that. So could we get a bigger pullback in our current pullback here in oil? It is very much possible. I am not saying that it can't pull back, but I can tell you this. We're in a declining wedge. It looks like it wants to break out to the upside. We've got China reopening. We are very low in the liquidity index, and things look like they could go higher. We also have a consolidation here. If I were to kind of put this back and run this, we do have which could be the start of here, got the wrong one there. This could be the end of this consolidation or very close to it. Maybe we come back one or two more times before heading higher. If I bought the bottom here, why wouldn't I just ride through it and use this as buying opportunities to accumulate more? What is so wrong with that? And if you really want to know, there is the Jesse Livermore accumulation cylinder, 1, 2, 3, 4, 5, 6, 7. You break up, you hit a peak, and this is towards the end of this cycle. This here is wave one, in my opinion. We've already gone through the Livermore cylinder. We broke out. We were running higher. They dumped a bunch of crude oil here at the top of the Strategic Petroleum Reserve release, and we've had our pullback. Think of it as an A, B, C correction between wave one and wave three, which is going to come in the future. And we can make projections off of this. Maybe the tightening cycle is almost done. Maybe a lot of those people are wrong in their short-term forecasts. And that's why I'm not buying any of the short-term forecasts. And yeah, I gave some projections of what maybe could do well next year. And all it is taking the short-term trends and saying, well, they're about to break out. I think they look good. That's why I chose natural gas, because we're at the end of a Jesse Livermore cylinder pattern. We probably have a couple more months to base out or consolidate, and then we'll see if we rip. Maybe it'll rip this summer of 2023. So I don't think, looking at this comment here, it makes me think that you haven't really been listening to the channel that much. So yeah, I made some 2023 expectations, and it's based off of the evidence that I have provided. But if we get a recession, maybe it will pull us back down. That is very much true. But trying to time this recession in the commodity super cycle, it's going to overlap more than just one recession. Or maybe it overlaps one recession, then we have the second one that blows it and pulls it all back. Or maybe we have multiple recessions. But trying to time that, I think, is very difficult, and I think a lot of people are going to get it wrong. What if you're trying to time the recession and the bull market happens? What are you going to do then? You're going to miss out on all those gains to the upside? You're going to miss out on a 10 or 20 or 30 bagger because you're scared that a potential recession that some people are talking about on YouTube is going to happen? Or you buy at what is the pivotal point, you cost average in the best you can at support levels and not try to predict the recession and ride through it if we get it, which could pull us back. It very well could. But guess what? Recessions don't last very long usually. I don't think it will be a depression. A depression comes from a great deleveraging in the housing market. Now that could happen in other currencies. That very well could happen over in Australia or somewhere over there. But I don't know the impact it would have on a gigantic shortage of oil in the markets and commodities in general. So we'll see. We'll see. I'm not in the camp that I'm not looking at this like everything's going to fall apart. And maybe you do, and maybe you're going to have a different approach. It's perfectly fine. My approach is there's shortages in the market. The patterns that are created technically look very good for upside potential in oil, natural gas, whatever. They're coming to the end of their consolidation of what I consider to be the first wave. And I think the biggest one is always wave number 3. Maybe the Federal Reserve is trying to increase interest rates and try to cause a recession to stop wave 3 of this massive move that's coming. They probably know it's coming, and I don't know if they can stop it or not. The 2008 Great Financial Crisis, I think, killed something on the lines of like 2 million barrels. We're probably going to be short this next year 2 or 3 million barrels above pumping capacity. So we could see a major recession in order for the supply-demand to balance. And I'm just talking about could-bes. I'm not stating that this has to happen this way. No one knows the future. I am positioned for the risk-reward, and I'm happy to position that way given the risk-reward in the market. If you're not, then don't take it. It's just my opinion, guys. And I will say this. I didn't make any money listening to these YouTube people. Back in 2005, 6, 7, when I started listening, a lot of these guys, they just said the same thing over and over and over and over. They didn't nail any pivotal points. They didn't do anything. I'm talking a whole bunch of different people on YouTube. I started making money when I started making my own decisions. So what I would say is make your own decisions on what you want to do and then learn and refine from there and continually get better. That is where I started making money. And the most important thing, if I could go back and tell my old self what I could do differently, it's find someone like me and learn from me. If I could go back and teach myself this stuff when I was 22, 23, 24 years old, I would tell myself to go learn from someone like me. To compress how quickly you can learn is far more valuable. It's probably one of the most valuable things you can do, is to progress your way faster and faster to becoming a better investor. In order to do that, I think you have to know someone who's done this before. Now, could I make a right or wrong call? Oh, for sure. It's going to happen. Everyone's human. And even if I were to make a wrong call, it's going to be okay, guys. It's going to be okay. No one's going to get this perfect. No one's going to get it right in every single turn. My strategy, and I've said this before, I'm going to ride through it. I'm not going to try to time this recession that people are talking about. I'm going to ride through it because I think that the supply-demand fundamentals, the structural fundamentals, are not solved. We have not brought on supply in sufficient quantities for mankind to progress forward like mankind wants to progress forward. We are in the middle of the S-curves for energy consumption in two countries, which are the largest two countries in the world, India and China. They are going to use more energy, and right now, that energy is oil, natural gas, nuclear, and all these other energy-based energy, we'll call it power generation sources. So that's the way that I look at it. And if I have to ride through a recession in the short term, so be it. That doesn't mean that if we get a recession and commodities pull back, that there's no super cycle. You're still in a super cycle, but you're going through a recession. Now, when is this recession going to occur? When's it going to happen? And you know what? No one's going to know. That's the thing. No one is going to know. And that's why I'm not going to try to time it. If I'm getting positive signals on my technical analysis for natural gas to go higher, for oil to go higher, for all these things to go higher, you know what I'm going to do? I'm going to listen. I'm going to use those signals to my advantage and take the risk-reward bet. And if we get a recession, so be it. It's the way it is. I'll ride through it. I'll live another day. I'll invest more money at the bottom and keep riding through it. All right, guys, that's what I've got for today. If you guys need any help riding through this commodity bull cycle, sign up, finding-value.com, the Platinum membership, use the word discount. Get yourself a discount. It's only for the Platinum members. You can do the Platinum yearly. You get a little bit more of a discount than you do with the monthly. The monthly only is a discount for 1 month. It's not for forever. The yearly, you're going to get a lot more discount, and you'll be signed up for a year. Just an FYI. If you like the content, give me a thumbs up, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.